Banks don't just fail because of bad loans. Sometimes, safe assets like government bonds can sink them. That's market risk, and it's exactly what toppled Silicon Valley Bank in 2023. In the next few minutes, I'll show you how market risk works, why SVB collapsed, and why it matters for every bank today. Market risk is the risk of losses in positions arising from movements in market variables, such as prices and volatility. Put simply, market risk is the danger that prices move against you. Interest rates, stock markets, currencies, and commodities, when they swing, banks and investors can lose money. Market risk can be classified into four main types: interest rate risk, which refers to bond prices fall when rates rise; equity risk, which refers to losses when stock prices tumble; currency risk, which refers to shift of exchange rates against you; commodity risk, which refers to swings in oil, metals, or food prices. For banks, interest rate risk is often the biggest one. The basic accounting equation is assets equals liabilities plus equity. As of December 2022, SVB's balance sheet showed $212 billion in assets, which include $120.1 billion in securities, mostly long-term treasuries and mortgage bonds, $74 billion in net loans and advances, $14 billion in cash and cash equivalents. On the other side, liabilities total $196 billion, of which $173 billion were customer deposits. SVB's total equity stood at $16 billion. The problem: most of SVB's investments were locked into long-term bonds, stretching 15 years or over 15 years. When the Federal Reserve hiked interest rates in 2022 and 2023, bond values collapsed. SVB's portfolio showed unrealized losses of around $15 billion, wiping out its capital base. Initially, those losses were hidden under hold-to-maturity accounting. But when depositors, primarily tech startups, began pulling their funds, SVB was forced to sell bonds at steep losses. Confidence evaporated. Withdrawals surged. The bank failed. This was a textbook case of interest rate market risk, where rising rates triggered a collapse by eroding asset values, draining liquidity, and destroying trust. Want the full picture? Download the SVB case snapshot, available in the description of this video. The problem started with rising bond rates. When rates go up, bond values crash. SVB held billions in long-term bonds. Suddenly, those assets were bleeding losses. But here's the twist: SVB's funding base was fragile, built on fast-moving deposits. Losses met panic. Panic met Twitter. And market risk morphed into a full-blown bank run. Market risk can't be avoided, but it can be managed. Banks use hedging strategies, like interest rate swaps, and match the duration of assets and liabilities to reduce exposure. Strong capital buffers and liquidity planning also help absorb shocks. SVB's failure shows what happens when these defenses are weak or missing. Market risk means price moves, whether in interest rates, currencies, or equities, can erode value significantly over time. Interest rates matter most for banks holding long-term bonds, because even small shifts can dramatically impact their asset valuations. Risk management, through hedging, duration matching, and capital buffers, is crucial to absorb shocks and maintain financial stability. SVB, a textbook case of interest rate market risk triggering a collapse, where asset losses collided with fragile funding and sparked panic. Market risk often remains invisible in day-to-day operations until prices suddenly shift, revealing how quickly asset values can erode. The collapse of Silicon Valley Bank shows how quickly even safe assets like government bonds can unravel when interest rates rise. Understanding market risk is key to understanding modern banking, as it explains how price movements directly affect banks' stability.